Hello, everyone. It's my pleasure. This is Mel Duncan, Research Director at AGREE, and it's my pleasure to welcome you to this second webinar that AGREE is producing with Stephanie Mercier, talking about farm programs in the U.S. And Stephanie is a former chief economist for the Senate Ag Committee and has been a real fellow traveler and helper to AGREE as we begin putting together some background research. So this presentation is part of a series we're doing that are what we're calling backgrounders that will inform discussion both within the AGREE group and also inform the broader debate about future directions for food and ag policy. So we're looking forward to your participation, and with that, I will let Stephanie take it away. Thanks, Stephanie.
Thank you, Mel, and looking forward to having the chance to give this presentation and then take questions after that. Let me scroll through to the beginning of the presentation. Okay. Today I'm going to talk about where things stand in terms of what the U.S. farm safety net programs look like. Okay. We'll start at the very beginning. We're talking about way back in the 1930s during the Great Depression. Why did we start having farm safety net programs at the time? It's basically threefold. Farmers are facing historically low commodity prices. A lot of them lost their crops as a result of the drought and the winds of the Dust Bowl that occurred not just once but and repeated over the period in the 1930s. And because so few of these farmers had alternatives to farming as sources of income, that meant that the average household income per farmer was a third of the national average at the time. So that was the main rationale at the time the U.S. government used to provide this safety net. And that first legislation was called the Agricultural Adjustment Act. It was passed in 1933, and it was enacted with the main goal of reducing agricultural output by paying farmers to withhold some of their land from cultivation in order to raise crop prices. So that was the start. And here we have a chart that shows sort of what's been the evolution of the composition of agriculture since we first started doing these programs. And 1919 actually predates by a few years the beginning of the farm programs, but you get a pretty clear picture of how big a share program crops were at the time, about 61%, as opposed to more recently the 2007 Census of Agriculture, only 29%. And even this is a little bit deceiving because the crops that are included under program crops in 2007 is actually a bigger set because it includes oilseed crops like soybeans and canola and peanuts, which were not considered to be program crops back at the beginning. So even though it's a bigger number of crops, it's actually a much smaller share of the total revenue that farmers receive. So that's a pretty important part of sort of the ferment, the politics of farm programs right now, is that 70 years ago, this was the main focus of farming, were these program crops, these main row crops, wheat, corn, soybeans, wheat, corn, rice, cotton, other feed grains. And now it's only really about a third of the value production in U.S. agriculture. Since 1933, there have been a number of policy refinements that have been added to the system. Over the years, Congress has tinkered with the support levels for crops to try to find the right mix, to try to find a way that the support prices didn't distort or skew farmers' decisions. Farmers could use those commodities as collateral for loans at legally set commodity loan rates, and then they could forfeit those crops to the government if their prices fell and the loan value became higher than the actual market value of those crops. Programs also provided for deficiency payments to farmers if prices fell below program target prices. Soil conservation became a key goal of programs pretty early on, and then they had to establish what were called annual set-asides, or they had to agree to not plant crops to a certain percentage of their acres in order to combat overproduction problems. And this is an interesting chart that shows you sort of what has been the motivation behind some of the changes that have occurred in farm programs. And we had in 1995 very strong exports, very robust global prices, And that was sort of set the stage for what happened in the 96 Farm Bill, was part of the reason why Congress was willing to step in and make so many changes. But then shortly after the 96 Farm Bill was passed, you saw a big drop-off in exports because there was a financial crisis in East Asia, and that's what caused Congress to sort of step back in and provide on an ad hoc basis some new programs, some new assistance that later evolved into new programs under the 02 and 08 Farm Bills. But I want to talk a little bit about how important the 1996 Farm Bill was as a watershed in agricultural policy. This is known as the Federal Agriculture Improvement and Reform, or FAIR Act. Was not involved with that acronym, so I won't take any credit for it. This represented a significant change in the way U.S. farm policy was structured. Some of the main changes was that it eliminated the annual set-aside requirement for program crops. It ended the deficiency payment target price system that discouraged farmers from shifting what crops they had grown. Now it gives them more incentive to change those crops in response to market signals. Under the previous set of farm programs, they had to plant that original crop in order to receive their payment. Then also established fixed decoupled payments that were linked to past production, which became known as base acres, with certainly the implication at the time that these payments would be limited in duration. They did retain the marketing assistance loan program, but with the belief that the high prices would continue, this loan program was not expected to kick in. So here, this is what the current structure of U.S. Farm Safety Net. When you talk to farm groups and a lot of farm state members, I've often talked about the three-legged stool that makes up the Farm Safety Net. And in that way, they talk about price income support programs like the countercyclical program, ACRE, marketing loan program as being that first leg. The second part of it is the ag disaster program, specifically, in particular, the crop insurance program. And then the third leg of that stool has always been the direct payments. But there are also additional legs if you want to talk about maybe adding a table to that three-legged stool, because they also have the ability to call on farm loan and related credit programs if they grow specialty crops instead of row crops, so they have our own entirely different set of programs. And then there's the biofuels policies, which are also important to agriculture, and conservation environmental programs, and then there's an additional set of sort of miscellaneous authorities. So how did we get to this current structure? As I mentioned, within a few years after the passage of the FAIR Act, Congress began to go back to its old habits of piling new programs on top of old ones, a process I begin to call policy accretion. This Asian financial crisis that I mentioned in the late 1990s led to a decline in demand for U.S. agricultural exports, and we saw a considerable drop in commodity prices and farm incomes. Congress responded in 1998 through 2001 by providing what they called market loss assistance payments, which were essentially just an additional chunk of payments based off of the direct payment composition, and they actually totaled $19 billion over a four-year period, so pretty substantial amount of money involved. And then in the 2002 Farm Bill, they established the countercyclical, price-based countercyclical payment program, or CCP, that was essentially a statutory replacement for those ad hoc market loss assistance payments. And then finally, the CCP was supplemented, not replaced, by a revenue-based program, which is called the Average Crop Revenue Election, or ACRE, as an option in the last Farm Bill. And here's a graphic that shows why Congress felt it was so important to step in and provide those additional payments. The blue line shows a chart of what the net farm income actually was over that period, and the red line, well below that, shows what farm income would have been in those 4 years without the emergency payments. On average, those additional payments, specifically, in particular, the market loss assistance, added about $7 billion a year annually to farm income. So I'm going to give a brief description of all the components that make up the income farm safety net for program crops. And the first piece of that puzzle is known as the Marketing Assistance Loan Program. This program provides loans on commodities that help farmers smooth their cash flow and generates income support to farmers when prices are particularly low. In order to minimize forfeitures and not allow the government to build up stocks, farmers can instead request a payment on that gap between the market price and the loan rate, and that's known as a loan deficiency payment, or LDP. Marketing Assistance Loan Program started back in 1985. So that's really the oldest of the surviving set of programs right now. The next piece of the puzzle was the direct payment program, provides payments based on historical production, regardless of the prevailing market conditions. This is part of the 1996 Farm Bill, and as we'll discuss later on, this is one piece that looks like it's probably going away in the next Farm Bill. One thing to note is the Marketing Assistance Loan Program is available to all the program crops, but there's also a loan available to producers of wool, mohair, and honey. So that's sort of a side note, but it's important to those folks. The third and fourth component of this basic safety net are the countercyclical payment program, which pays on fixed acres and yields when the price for a given program crop falls below the level that's established in law. This does not require that the crop in question be planted, but it does require that that land be in what's called an agricultural use. So you have to do something on that land related to agriculture, like graze livestock or something, but it can't be totally idle. This was put in the mix as part of the 2002 Farm Bill. And then the newest piece of the puzzle is the average crop revenue election or acre program. This pays when the state average revenue falls below an established target level. It pays on actual planted acres rather than a historical base. Enrollment in this program is optional. It requires that farmers give up the CCP, so it's essentially an alternative to the CCP, but they also must accept a lower direct payment and a lower loan rate. They must also have a minimal loss at the farm level in order to qualify for a payment. This was part of the 2008 Farm Bill. Acre has not really done well in terms of attracting farmers to enroll in it. The last data that I saw was through 2010, and only 14% of all base acres were enrolled in the acre program as opposed to the CCP, and most of that is wheat, corn, and soybeans. Very little enrollment by producers of other crops. So these are the four major pieces of what's really the farm safety net, at least two legs of that farm safety net, of that three-legged stool. And here's a chart that gives us a little bit more summary, a little more detail about some of the parameters of this program. Marketing loan program, both that and the CCP has had relatively low spending in the last few years because we've had relatively high prices. The fourth column here gives you a sense of what is the concentration of payments that goes to the top 10% of all producers. It ranges from 50% at the low for the acre program up to 76% for the CCP. And part of that is because, certainly in the CCP, is that it's only actually kicked in for a couple of crops on a regular basis. If you grow mostly wheat and soybeans, you've never gotten a CCP since 2002. Most of that's gone to cotton and rice, and there's actually was, I think, a couple of years where corn producers got a CCP. But so part of the skewness of that figure is related to the fact that it hasn't kicked in for some crops at all. And then the last column shows you what the top states are for recipients under those programs. And we're looking at Midwest states, and for the CCP, Texas, Georgia, Mississippi, because of cotton and rice. Direct payment, again, we're looking at the Midwest states and Texas as being the largest recipients. Next piece I want to talk about is the sugar program. And this is one of those sort of unique creations because there's very little resemblance to what the programs are for the other row crop producers. For the sugar program, you do have a loan program. Loans are available to processors holding semi-processed product. It goes to the processors and not to the actual farmers because cane and beets are perishable in their raw state, and so they're not really amenable to long-term storage. Product can be forfeited if the price falls below the loan rate. So in that sense, that element is somewhat similar. But then they have additional components that make it very different. They have a marketing allotment approach, which divides up the allowable share of domestic sugar beet and cane production between the processors of those two crops on a state-by-state basis. And if you produce crop in excess of the state's allotment, you cannot market it. So it essentially goes to waste. So it's a pretty rigid system. They also have a very new program called the Feedstock Flexibility Program, which allows excess sugar to be sold by USDA at a discount to ethanol producers. They haven't implemented it yet. It was part of the 08 Farm Bill because the world prices ended up being a lot higher than they thought at the time. But the sense was that if we got more imports because of the new trade agreements and all that stuff, that rather than cut back on the allotments to the domestic production, you would divert some of the sugar to ethanol production and keep prices high. So that was the rationale for that program. It hasn't been implemented yet because the prices have been a lot higher than they thought. The price support system is supported by what's called a tariff rate quota, or TRQ system, which is legal under the World Trade Organization. It essentially assigns an allotment to a bunch of different sugar-producing countries. So that's the WTO part of the TRQ, but that particular system is facing a lot of erosion because a lot of the new free trade agreements that we've done since the GATT back in 1994 have included additional allotments or TRQs for sugar outside of what they get under the WTO, and so that's part of the reason why you have the pressure on the system. The sugar support is provided largely by consumers paying a higher price than the world if it were at the world price. The industry takes a lot of pride in what they call the no-net cost aspect of the sugar program, because the benefits, the support provided to sugar producers comes essentially through higher consumer prices rather than through direct outlays by taxpayers. And similarly, dairy is unique because it's the only one of the livestock groups that has a formal support program, and it's in some ways very similar to what sugar has. They have product price supports. The system establishes a price floor for the main products in the dairy complex, for butter, for cheese, for non-fat dry milk, powder. USDA can purchase this at support prices to take the product out to market if the product is of the right quality. And then they also have a milk marketing order system that applies across the country. This segments milk price by the final use of the product, and is designed to foster orderly marketing in regions of the country. And not that long ago, there were like 30 or 40 different marketing order systems, and was very confused. And they've had some reforms since then, and I think they're down to like only 10 marketing order systems, which accounts for about 60% of production. California has its own marketing order system, but it's not part of the federal system, so it makes them somewhat of a unique entity. And then a more newer part of this system is what's called the Milk Income Loss Contract, or MILC. This provides a deficiency payment for dairy producers based off of the Northeast Class 1 price. Class 1 is for milk that's designated for human consumption. That price is $16.94 a hundredweight. Payments are limited. This is a very severely payment-limited program. You can get payments if you have production on up to about 160 cows, and any additional cows above that, you don't get any more payments for that. This pays on 45% of the gap between the target price and the actual price on a monthly basis. Except for this new MILC program, again, as with sugar, most of the cost burden of this program falls on consumers in the form of higher prices, not taxpayers. Again, as with sugar, it's supported by TRQs on imports of most major products, dairy product categories. There are big regional differences between the dairy farm structures, relatively small farms in the Northeast and Midwest, and very large operations in the West. That has led to very heated policy debates in recent farm bills and continues to this day. And here's a map of the U.S. that shows that pretty graphically as to what the split is between the parts of the country in terms of the average size of the dairy farms. The darker colors, the dark blues and purples, are almost entirely in the West. Much smaller farm sizes are in the Northeast and upper Midwest, like Wisconsin, Minnesota. So that's part of the very important politics of dairy policy is this regional split. And then here's the third leg of that three-legged stool that I talked about at the beginning, are the programs which provide assistance to farmers in the event of a natural disaster, which are known as agricultural disaster assistance. Almost every new ag disaster program over the last few decades has been established with the goal of ending the use of ad hoc programs passed by Congress to satisfy the demands of constituents who recently faced a serious natural disaster. But through fiscal 2010, Congress hadn't quite gotten to that point. Although I will point out that the fiscal 2010 ad hoc package was not actually passed by Congress. It was provided administratively by USDA based on Section 32 authority. So in that respect, they met the goal in that Congress didn't actually pass this, but for political reasons, I would say the administration went ahead and provided a modest ad hoc package for crop losses in 2010. As with farm support programs, the process of developing ag disaster programs has been, again, a process of accretion, programs being added over time to address perceived gaps in coverage, with few, if any, of them actually being eliminated in the process. So that's why you get sort of a hodgepodge of programs across all of these the safety net issues. The biggest part of the major component of the ag disaster assistance leg of that stool is the federal crop insurance program. This program was made widely available across the country in 1981 and has expanded greatly since then. It's required under law to be actuarially sound, which means that the expected losses under the program are supposed to equal the total premium paid, but the government pays a pretty substantial portion of that premium, so it's a subsidized system. The program is delivered by private companies who are reimbursed for their expenses and also able to capture underwriting gains out of the program. There are actually policies available for more than 100 crops, but 75% of the coverage by value is for 3 crops. These are also crops that have the largest acres, corn, soybeans, and wheat. The second part of the package of ag disaster is what's called the non-insured crop disaster program, or NAP. And this is essentially available for crops for which there is no federal crop insurance policy. It's administered by the Farm Service Agency. It provides a very small indemnity, up to 27.5% of the value of the crop if it's entirely lost, for a fee of $250 per crop per county. There's no risk-based premium associated with the NAP program. This was established in the 1996 Farm Bill. And here's a chart which shows you sort of the evolution of participation in the federal crop insurance program. As I mentioned previously, this really started in 1981 and kind of crawled along. The first really big development in terms of policy occurred as part of the 1994 Crop Insurance Reform Act, when Congress decided that in order for a farmer to participate in the other parts of the farm safety net, they had to sign up for crop insurance. And so you saw this big jump in crop insurance participation in acreage between 94 and 95. And then in 96, Congress said, we didn't really mean it. And they pulled it back, and so you got a big drop-off as a result in 96 as part of the FAIR Act. And so it sort of moved along again, and then you hit the late 90s when Congress decided they wanted to go back to try to encourage farmers to get into the crop insurance program. So as part of these ad hoc assistance packages, in addition to the market loss assistance programs, they also offered farmers additional discounts for buying crop insurance. And then when we got to 2000, when we had major crop insurance reform, part of that, a big chunk of the cost of that Ag Risk Protection Act, or what's known as ARPA, was to permanently increase the subsidies provided to crop insurance producers. And so that's why you start getting another jump in participation in 2000 and after that. And then the next sort of milestone in crop insurance in terms of participation was the introduction of coverage for pasture and rangeland, which was initially piloted, I think, in 2007 or 2008, and has resulted in a big increase in total acres covered under crop insurance, because now instead of just having row crops insured, you also have pasture and rangelands insured in big parts of the country. So that's sort of the history in a nutshell of what's going on with the crop insurance program. So even with crop insurance available, Congress has often stepped in with sizable ad hoc disaster programs over the years. And I went back and looked at some documentation that the Congressional Research Service has done over the years. And it turns out there have been 17 bills spending at least $300 million on ag disasters between 1988 and 2006. So some years they did more than one. So it's actually not on an annual basis, but it's pretty close. They hit a hurdle for the first time, really, in the administration of President George W. Bush, which for the first time in the history of ag disaster required offsets for ag disaster, and that sort of put a kibosh on an annual effort. So in response to that requirement, of that obstacle that was presented in the Bush administration, Congress decided that they would want to add a new standing disaster program with 5 different components was added in the 08 Farm Bill. And it's 5 pieces, the biggest part of which is this SURE program, which is essentially a whole farm crop disaster assistance program. And then 4 smaller pieces. One is the livestock indemnity program, which provides payment to farmers if they lose livestock due to like a flood or a drought or something like that. The next piece is the livestock forest disaster program, and that's for farmers who graze their livestock, mostly cattle. If there's a severe drought in their part of the country, it's essentially they get a payment based on what the National Weather Service says that the weather conditions are, rather than having to demonstrate for each farmer that they've lost forage or pasture. So it's a pretty straightforward program. The next small program is called the Tree Assistance Program, TAP, and that's for producers of orchard crops. If they lose their trees, so it's associated with the tree itself and not the fruit of the tree. And then the final piece is called the Emergency Assistance for Livestock, Honeybees, and Farm-Raised Fish, which I sort of call the grab bag program because it covers everything that isn't covered in one of the other programs. So this is the 5-part package that was added in the 2008 Farm Bill. This package is not particularly popular in the southern part of the U.S. because this new SURE program works best in combination with higher levels of crop insurance coverage, which is a lot more common in the Midwest and West, and a lot less common in the South, where a lot of farmers buy CAT coverage, which is a minimal crop insurance policy. The funding for SURE and these other programs runs out early. It's actually expired 2 months ago at the end of September. There will be a real big struggle to get new money in this current budget environment, especially since the projected cost of the program is now greater than it was at the time it was passed in the 2008 Farm Bill. So that's going to be one of the questions that gets addressed in the 2012 Farm Bill is, what do you do about these new standing disaster programs? Do you renew them? Do you modify them? Do you sort of fold them into other programs? Or do you let them go away? So it's a multi-choice there. Okay, this is a sort of related issue. Is what is the implication of the current high crop prices for these farm safety net programs? And at these very high current price levels, we expect very little payout from these countercyclical farm support programs. So there's just the marketing loan program, the countercyclical, and the ACRE program. ACRE could still pay out under some circumstances in states that had significant yield losses, such as the drought-stricken wheat crops in Texas and Oklahoma for the 2011 crop year. One of the drawbacks for the ACRE program is because they have to have a full-year marketing price to calculate the program, the payout isn't actually made until several months after the end of the crop year. Crop insurance outlays will remain high, in part because the premiums are assessed based on crop value. So if you have high crop prices, that means the liability and the premium for that crop gets higher. Direct payments will continue to pay out regardless of market conditions unless they get changed in this upcoming Farm Bill. Disaster program outlays are expected to be high in 2011 because we've had a lot of flooding and drought harming crops in key regions of the country. And I remember when Tropical Storm Irene came through the East Coast back in September, I guess it was, you heard reports in the press that was the 10th natural disaster in the United States in calendar 2011 that caused at least $1 billion in damage. So it's been a pretty nasty year in terms of natural disaster. And here's sort of a summary of where things stand in terms of those target prices under the CCP compared to where prices for these major crops actually are in 2011. And these prices are updated as of the last month's USDA WASDE report. And as you can see, the current market prices are quite a bit higher than those target prices in almost every case. And even though the guaranteed prices under ACRE are higher than the target prices for most of these, they're still quite a bit higher than the ACRE prices as well. So it's very unlikely that you're going to see a lot of payments for farmers under these programs for the 2011 crop. And the next category of programs I want to talk about briefly are the USDA loan programs. I want to differentiate a bit. There really are two sets of loan programs under USDA. One, which I already described as the marketing loan program, in which the collateral for the loan is essentially the crop itself. And that's always a short-term loan. It's can be no longer in duration than 9 months. And so that's the marketing loan program is for crops. And then there's a separate loan program that USDA offers, which provides either a loan for operating expenses for the farmer or for the ownership or repair of either land or facilities. Except for farm storage program, and that's an entirely different one. All of these programs are funded through the annual appropriations process rather than it being funded through mandatory funds through the Farm Bill. There are two kinds of loans under the Farm Service Agency loan program. One are the direct loans, which essentially USDA is the one that's actually doing the actual lending of the funds. And then the second category are what are called guaranteed loans, which essentially the farmer goes to his local bank and says, will you lend me money if I can get USDA to guarantee it for you? And so there's two categories there. For beginning farmers, there are special provisions in a lot of these different programs, including set-asides for USDA loan funds for a portion of the year, plus there's a down payment loan program assistance, and then they also have preferred access to farmland that gets forfeited to USDA due to defaults. So there's a number of things related to beginning farmers that happens through the credit programs at USDA. And then a whole new separate category of programs, or the provisions that were provided mostly in the 08 Farm Bill for specialty crop producers. 08 Farm Bill was really the first time that the specialty crop producers formed an effective political coalition, and they came in and said, well, we want our own piece of the pie here. Coalition declined to seek direct subsidies or other similar forms of support, so they don't have the same array of price supports and direct payments that row crop producers receive. Instead, they sought funds that would help them either increase demand for their product or reduce their production costs. They continued to maintain strong opposition to allowing specialty crops to be planted on base acres from row crop programs. This is known as the planting flexibility restrictions. The special crop title in the 08 Farm Bill was funded for about $1 billion over the 10-year baseline period, plus there were additional programs in other titles. I want to talk a little bit about some of the major components of that special crop assistance package. The biggest part of that are the specialty crop block grants, which are provided to state governments based on their share of overall specialty crop production. And so the biggest recipients under this program are states that you would expect. It's California, it's Florida, it's Washington State because of their apples, it's Texas because of their citrus. The cost of that program over the 10 years is about $466 million. Second big chunk of this is the Pest and Disease Management Research Program. It's aimed at helping with early pest detection and surveillance so that farmers know when there's going to be a problem. There's also funds that provide clean, untainted, propagated material to growers. And there's a specialty crop research initiative, which is not part of that $1 billion that I talked about, but it's a separate pot of $230 million that's in the Ag-Research title of the last Farm Bill. And then the last category that's in the special crop title are the programs aimed at organic crop production for a total of $107 million. And these consist of such activities as providing cost share to farmers who want to convert their operations from conventional production to organic production because of the very prescriptive rules on how that process occurs. My understanding is it often takes 2 or 3 years to actually get to the point from when you stop producing with conventional fertilizers and other chemicals to when you can be fully classified as organic. And so there are certain costs associated with that process that USDA has this program that provides some cost share for that purpose. There's also funding that is going towards the better collecting of data and reporting on organic production as opposed to conventional crops. And then there's special funds that are available for organic research and extension activities. And then a separate program that's also focused on technical crops, on specialty crops, is a program that's called Technical Assistance for Specialty Crops, or TASC. And this is included in the trade title rather than the specialty crop title. It's essentially grants that are limited only to specialty crop producers to help them resolve sanitary and phytosanitary issues that arise associated with trade in their crops. And then I want to talk about federal biofuels policy. Although it's not strictly part of the Farm Safety Net and a lot of the components of it are outside of the Agriculture Committee, biofuels policy has had an outsized effect on U.S. agriculture in recent years. And sort of graphically, since 2002, U.S. ethanol demand for corn has increased by nearly 3 billion bushels, which translates to about 20 million additional acres of corn at average U.S. yields. Corn use for ethanol is projected by the U.S. Department of Agriculture to actually exceed demand for livestock feed in 2011, although the industry thinks that USDA's numbers are a bit high. So that's a pretty significant change in sort of the composition of demand for corn. So much more of that is now ethanol as opposed to livestock feed. There are several different components to federal biofuels policy. and a lot of these are outside the jurisdiction of the Agriculture Committee. One is the blender's credit. This is a tax subsidy that helps ethanol and biodiesel compete with petroleum-based fuels. The current level for ethanol is 45 cents a gallon. This credit actually expires at the end of 2011, and hardly anybody expects it's going to be renewed, so most people believe that this part of it is probably going away. There's also a related import tariff on ethanol, 51 cents a gallon, which discourages imports. This was assessed because of the incidence of the blender's credit. The blender's credit is captured at the point where the ethanol is blended with a conventional gasoline, and so they don't differentiate at that point between whether it's produced in the U.S. or produced overseas, and so that tariff is assessed in order to sort of offset that benefit. And then the next piece of the puzzle for federal biofuels policy is called the Renewable Fuel Standard, or RFS, and this establishes a requirement for the minimum use of biofuels in the U.S. transportation fuel sector. Next piece, and this is more that is actually part of the Farm Bill, is the research and development on biomass as a new source of feedstock for biofuels that goes past beyond the use of corn for ethanol and soybean oil for biodiesel. This is focused largely on developing and growing feedstocks and making conversion technology for the second-generation biofuels from cellulosic materials more economical. And then finally, the last piece are grants and loans aimed at helping entrepreneurs establish biorefineries. And both the U.S. Department of Agriculture and the Department of Energy have these types of programs. Again, these are also limited to the so-called second-generation facilities for the use of biomass or cellulosic material. And here's a chart that shows you what has been the sort of the evolution of biofuels production and how that's been related to this renewable fuel standard. We've actually had two sets of renewable fuel standards. The first one was passed as part of legislation back in 2005, and that's this lower green line. And as you can see, it wasn't terribly aggressive, and U.S. ethanol producers had no problems in producing ethanol well above what the minimum was. And then the yellow line is the RFS 2 associated with the more recent Energy Independence and Security Act of 2007, and it carries us out through I think 2025, and the requirement is that by that point we're supposed to be producing 35 billion gallons of renewable fuel. The blue line starts at the beginning, and you can see that almost every year renewable fuel production is actually exceeded what the mandate is. I think 2009 it was right at the level. But so the RFS has never been binding on the U.S. Biofuels industry, but it's always been part of the policy mix, at least through since 2005. What are some of the implications of this policy on agriculture? First, the important one is the land use impacts. We had 92 million acres of corn planted in 2011, which is a 14% increase over what we had in 2004 before this big recent burst of renewable fuel production. The gain in production was initially from other row crops, but a big factor right now is that there's more land available from more double cropping of wheat and soybeans in the Midwest, and that has freed up some additional acres for corn. There's been a price impact involved with this. We saw a big, dramatic increase in crop prices in 2007, 2008, and this led to a lot of discussion about food versus fuel, and is this an appropriate choice to make? I think more recent analysis suggests now that biofuels is only one of many factors that contributed to that, but it's clearly part of the public debate now. Farm program spending, the higher prices that we're seeing in crops, has, due to all factors, not just biofuels, has led to a significant drop in farm program spending. But we've also had, at the same time, an increase in crop insurance spending. So, but still, between the two, there's been a significant net decline of total safety net spending since 2004. And then finally, what's been the impact on the livestock sector? And you have to say it's been considerable. Total feed costs for 2011 are forecast by the USDA at $54.6 billion, and that's almost a 100% increase in the last 8 years. So you can see why the livestock folks are concerned. Next category I want to talk about a little bit are the conservation or environmental programs. As I mentioned early on, improved soil conservation practices have been a goal. Farm support from almost the very beginning. This is in response to what happened to topsoil in the Midwest and the Great Plains as a result of the Dust Bowl. But conservation-focused programs are relatively new to the mix. First, we started with programs that were intended to retire environmentally sensitive land. These were also intended to relieve pressure on this annual set-aside process. The first one of these was the Conservation Reserve Program in the 85 Farm Bill. And then since then, we've had numerous smaller programs designed to encourage farmers to adopt better conserving practices or working land programs. These were consolidated into one larger program in the 1996 Farm Bill called EQIP. Farmers using most farm support and loan programs must also abide by rules restricting cultivation on wetlands or highly lowerable cropland. This set of rules is known as conservation compliance, dates back to 1985. These rules do not apply to participation in the crop insurance program. Talk specifically about some of the major programs under this category, the land retirement or easement programs. The biggest one of all is Conservation Reserve Program. Main focus is removing land prone to soil erosion from production. Farmers can contract to retire their land for either 10 or 15 years, and this qualify for this program through a centralized bidding process. Under current law, the CRP is capped at 32 million acres. One of the good things of this program is it does have a baseline, so it would presumably continue in the next Farm Bill unless changes are made. The second category, the second program in this category is the Wetlands Reserve Program dating back to 1990. It's aimed at keeping wetlands out of ag production. Contracts can be either to as easements, either for 30 years or a permanent easement, or they can provide for a 10-year cost share to farmers to help them rehabilitate their wetlands. Under WRP, the funds are allocated to the state conservation directors who then make decisions on who in their state gets to enroll. Wetlands Reserve Program does not have a baseline for the 2012 Farm Bill, so it's one of those programs that's going to have some more problems getting renewed than the CRP would. And then the third program in this category is the Grassland Reserve Program, and that was established in the 2002 Farm Bill. It's provided incentives to owners of grassland, rangeland, or pasture land to either restore or conserve that land. Not more than 60% of the enrolled acres can go into easements. The rest go into rental agreements of 10 to 20 years. And this is also, like the Wetlands Reserve Program, does not have a baseline past 2012, and so this one will face challenges as well. Okay, the second major category of conservation programs are what I like to call the working lands program, which means that these are for putting new practices into land that is being cultivated. The biggest one of these is the Environmental Quality Incentive Program, or EQIP, started in the 96 Farm Bill. This provides cost share, financial assistance, and technical assistance to farmers to promote environmental quality on farmland still in production. Under law, 60% of the funding has to go to livestock operations, so livestock groups like this program a lot. The second major one in this category is the Conservation Stewardship Program. It was established under a different name in the 2002 Farm Bill. This is designed to treat agriculture conservation in a more comprehensive manner and is intended to reward farmers and ranchers who already meet pretty high standards of conservation management on their operations. This is also a cost share program. And here are some of the key elements of these conservation programs. As I showed for the Farm Safety Net programs, recent spending levels, CRP at the top is the biggest one at almost $2 billion a year. WRP about $600 million, EQIP about $1.2 million, and then conservation stewardship about $650. All of these are mandatory programs, but they are not really formally entitlement programs because they're all capped in some way for either in terms of acreage that's eligible or for EQIP and CSP funding caps. The distribution of payments, again, shown in that fourth column, see quite a range. Lowest is 37%. Of the payments go to the top 10% is for the CSP program, and then the highest concentration is for the Wetlands Reserve Program, which is 74%. So literally double what CSPs is. And in the final column, you can see the states where the biggest numbers of participants are in these states. And you see quite a bit of overlap here. I mean, you see Texas and Iowa and Kansas and a lot of these programs. And then the final category of programs that I want to talk about are the forestry programs. Most of the policies that are related to forestry incentives actually occur through the tax code and not through direct incentive programs, but there are two specifically that deal with forestry that are in the Farm Bill. One is the Healthy Forest Reserve Program, designed to help reduce the risk of wildfires by thinning undergrowth and brush in forested areas. And this is provided either through a 10-year cost share program